let's talk inside baseball.
You might not know Kenvue, but Kenvue is Johnson & Johnson's former consumer brands company. It was spun out just a couple years ago, and now already that spin-out is being bought by Kimberly-Clark, a giant personal consumer brands company.
We're going to cover that today on Altimetry Authority, and we're also going to dig into a 3-minute drill that one of our subscribers asked us about for Atlassian.
Let's take a look today on the Altimetry Authority show.
Let's talk earnings and favorite pastime.
So let me just say, earnings
Wall Street
That's
2.5x.
because their compensation goes up.
Wall Street's wrong again. Kenvue looks like it has gotten a guardian angel swooping in after all of the Tylenol debacle that's hit over the last few months. Obviously, after the administration started talking about the idea that Tylenol may or may not be a contributing factor to autism, there is research out there that shows it. There's doctors that don't. By the way, not our job to have an opinion on that. What it is our job to tell you is whether or not that means that Kimberly-Clark, which just swooped in to buy Tylenol-Maker Kenvue for $40 billion, got a really smart value for the business or not. And so let's take a look, right? From the whole entire rumors about whether or not the administration was going to say something about Tylenol, and then the actual break led to the stock for Kenvue over the last few months dropping 30%. That's down $9 billion in market cap for Kenvue. Got all the way down to $14.
And a lot of people, they're not familiar with Kenvue because Kenvue is a recent brand. That said, if you look around your house, your bathroom, your kitchen, you probably have 10 or more Kenvue products because Kenvue is Johnson & Johnson consumer products. So Johnson & Johnson Baby Shampoo, Tylenol, all kinds of, breath fresheners and you name it, and home personal care, things that you thought were Johnson & Johnson, and they still have the Johnson & Johnson brand, are not owned by Johnson & Johnson. Johnson & Johnson, the company, spun out Kenvue, will off the personal products. And Johnson & Johnson, the name of the company, J&J, is still a big pharmaceutical company and medicines and you name it, things that you probably are aware of. But the stuff that is a household name of J&J is actually under Kenvue. Kenvue is the company that owns it. It was spun out only a couple years ago. Now, Kenvue, as Rob said, hasn't had the best time since its IPO. Stock is down a lot. It's down $9 billion in market cap. And so Kimberly-Clark, a big personal care giant, is saying, personal products giant, consumer products giant, hey, maybe it's down $10 billion. It's cheap, and we should swoop in, as Rob says, and just buy it up.
So now here's the context. So what is Kimberly-Clark paying? So this is the stock price that Kimberly-Clark is paying, right? They're paying $21 billion, $21 in terms of stock price for the $40 billion acquisition. And, for context, everybody, when you think about whether or not you think that there is a thing for Tylenol, again, not our job. What the important thing is, lawsuits will fly. And when you look at other lawsuits that have happened in the consumer product space, the Fen-Phens of the world, the earplugs for 3M, there's generally, when you get big consumer product liabilities like this, $3 to $6 billion kind of tends to be an all right thing. You could see something as high as $10 billion, but just for context, right, you had this company lose $10 billion in the market cap, $9 billion, and basically Kimberly-Clark has wiped it out. So let's take a look, Joel. Is this a good value for Kimberly-Clark in terms of what they're paying for Kenvue or not? Let's take everybody through the numbers.
Well, Kenvue's returns, these are household names, so the question isn't, is it a good company? It is a great company. The returns are, a little bit kind of cyclical for a company that's a staples, right? You do think that since the IPO, things are a little bit shaky in terms of normally consumer products companies are super stable because you're selling the same amount of, breath freshener every year, saying the same amount of Tylenol every year or slightly higher. But either way, these returns are well in the 35% return on asset range, strong earning power. Wall Street analysts, though, are saying, nah, this 2024 is a blip. You're really on this curve of 2025 being bad. Maybe you rebound in 2026 a little bit. That's what Wall Street analysts are pushing in when we look at it from a uniform accounting standpoint. Now, the stock market, what's embedding is that returns are going to keep falling down to a 25% level. 25% is still double the U.S. corporate average, but it isn't the close to 50% that we saw packaged inside this consumer packaged company that we saw just 5 years ago. So the market has kind of a down look on the value of this company.
Right. And so if you look, what the market was basically saying, because this is what the market was pricing the company to do, setting the line the day before the acquisition was announced, when it was trading at about $14 a share. The market was basically pricing in, right, the equivalent of, hey, this company is going to get hit with some lawsuits and might lose some profitability here. Makes sense. Now, everybody, here's at the $21 stock price that Kimberly-Clark is offering to pay for Kenvue, what Kimberly-Clark is paying for. Now, Joel, I don't know about you, but this doesn't look like a company that's being priced at these valuations for any litigation risk or anything else a problem for the business. Does it to you?
Now, these returns in perpetuity from, right, call that 30-something% in perpetuity is what, a good consumer brand company should get for profitability that's been around for 50, 60, 70 years with brands that everyone knows. It should get those kinds of returns, but that does not price in that those returns are lower because they've got a talcum powder case, because they have a potential Tylenol case, and what have you. So if you felt that that litigation would result in nothing spent, you might say, okay, these returns are good, and Kimberly-Clark is getting a good deal. But if you think it's this minus $3 billion, $6 billion, $8 billion, or whatever it might be, the cost of that, then you'd say maybe they're paying up. Maybe they're paying a little too high. And the market prior to Kimberly-Clark's acquisition announcement may have been more right.
Either way, I mean, what it tells everybody is they're not getting a deal no matter what Kimberly-Clark is. They're probably paying full value for the steady state business is what they're paying. So this is not one that we would say necessarily to say, hey, this acquirer got a steal by buying a distressed asset. It looks like this acquirer saw a distressed asset and said, you know what I'm going to do? I'm going to pay full price. And that's basically
As
what
if
it
there's
looks
no
like
distress. Yeah.
Exactly, right. And so that's what's looking at here. Now, everybody, before we wrap for today, we also had a viewer ask us to do a 3-minute drill and set the line on another company, Atlassian. And so, Joel, let's lay actually, just before we do, just everybody, for those of you who don't know Atlassian, for those who, unlike Joel and I, don't have to live in the world of dealing with dev teams and Jira and Scrums and Confluence and everything else, Atlassian basically sells products that help for productivity for dev teams and teams in general, but really specifically for development teams to be able to build products. It helps them manage how they do that. So that's a good backdrop of what Atlassian does. Now, Joel, let's do a 3-minute drill and show everybody for what the real numbers are and what the market's thinking.
As reported price to earnings ratio, this is the number that you'd see for its price to earnings ratio over the last, since 2021. It was an extremely expensive company with 200 times earnings, according to GAAP accounting. And that PE has been falling over the years to something to get to some level of normalcy. Now, what's economic reality? Economic reality is that this company actually has PEs that were high, have been high, and are still high. This is still a 200 times PE company. And you get that when you look at uniform earnings, you look at uniform accounting, it is still really expensive. Another way of seeing that it's that expensive is look at its bad earnings years of 21 and 22. This is uniform accounting. This is not what you're going to see in Reuters and Bloomberg because their numbers are wrong. Their numbers are bad. Any GAAP accounting numbers do not represent economic reality. These numbers do. You can see the ROE. It does jump into like a, 5% level in 24, 25. That's close to the global corporate average, nowhere near the U.S. corporate average of 12 to 14. And Wall Street's saying, all right, 2027, though, that's going to be a really good year, but still only at something like 8% returns. Nothing here is like, this is some fantastic tech company with the software of the future and what have you. Nothing here says that. Now, what the market is pricing in, right, at this price, is another way of saying, what does a 200 times earnings multiple mean? It says that this company is going to sell like crazy. This means they're going to sell a lot more license to a lot more people, a lot more often, with a lot higher prices, and they're going to repeat that every year for like the next 5 years. A lot more, because they're going to get to something like a 35% return. Now, at that point, you're saying this is getting to reach, Google and Meta levels of returns, Amazon and, its heyday. Do you even know who Atlassian is and what they can do? I'm not saying you can't research them and see what's behind their $43 billion market cap, but It's a lot. It's a lot embedded. That's the over-under.
And I mean, and everybody, to put that in perspective, right? And this is the whole entire thing. People may look at this company and go, oh, look at the PE's gotten for a growth company in software. It's gotten cheap. This is not a cheap PE company. And when you think about it, what the market's basically pricing it is, they're going to have a scaled SaaS business, just like anybody else who scaled SaaS. And what you're missing is what you may be missing. When you think about developers, one of the areas of the economy and the job market that's actually most being impacted by AI is developers and coders. And so if you think, do you need more Jira and Confluence instances, which are the platforms that these developers use, if you're going to have fewer developers to do the same amount of work? You probably don't. Do you need that actually solution if you could possibly build that solution with AI? There's a lot of reasons why teams might actually be the kind of business that's the most under threat from AI, not a beneficiary, and yet the market's just completely saying, hear no evil, see no evil, speak no evil. And so when you see that going on, it's a reason for everybody where we think, maybe the line looks a little high here. So everybody, if you have a company you want us to look at and do a 3-minute drill like Atlassian, feel free to drop it in the comments below and hit the like and subscribe button if you enjoyed this, and come back for next time, because that is this episode of Altimetry Authority. Thanks, everybody.